Always a great day when one of our favorite income covered call providers in Canada launches 4 new ETFs, actually 16 in total. We'll talk about that. But Harvest has launched a brand new suite of single stock ETFs, income obviously, so they have covered call writing on them, and they have leveraged and non-leveraged versions, as well as USD currency and non Canadian currency versions as well. So let's check them out. I am on their website here, High Income Shares by Harvest ETF. So these are single stock ETF, which means the ETFs will only be investing in one stock. They have started with these 4 stocks: Lilly, which is a massive healthcare pharmaceutical company that's been on a tear lately. If you look at the stock chart, I mean, it almost looks like NVIDIA. Of course, you have Amazon, you have Microsoft, two consumer discretionary giant, technology giant, and of course you have NVIDIA, who's at the forefront with the chip making. So let's check out these products together and what they're all about. So if we scroll down, you will actually see, hopefully my face is not blocking anything, that's why I put it at the top instead of at the bottom here. So they started with 4 companies, and they're going to have not only unleveraged and leveraged versions of each, but also Canadian currency and USD currency versions of each one, leverage and non-leverage. So for example, let's just take Lilly. So you're going to have LLHY, that's just going to be the Canadian currency non-leveraged. Then you have LLYH.U. This is USD currency, right? Whenever you see a .U, it typically means in USD currency. And then you have the same thing for the leverage versions. You have LLHE for if you want to trade it in Canadian dollars, and you have the .U version if you want to trade it in USD dollars. However, one thing that's interesting is that all of them, every single one of them, are not going to be hedged to the Canadian dollar, which I kind of like, because if you feel like the US dollar will do better versus Canada over time, you are going to be better off with a non-hedged version. So all of these, every single one of them, there is no Canadian dollar hedging, and that saves a little bit of costs as well. We're going to ask Michael Kovacs about it later on. So this is just something that's I noticed that's different, because a lot of Harvest covered call ETFs are Canadian dollar hedged. These ones are all non-hedged. So I just want to point that out. Very, very important. The management fee is 40 basis points on all of these, so very nice low management fee. Of course, the leverage one has to pay for leverage costs, so the MER on those ones are going to be higher, obviously. But rate cuts with interest rates going down in Canada, that definitely helps or reduces the leverage costs on the leverage versions, which are these ones here, right? So an easy way to find them, by the way, they're going to have enhanced in the name. And another thing I want to point out is that all of them, whether it's a .U one or not, they are all listed on the TSX. They're all listed on the Canadian stock market, so you do not have to worry about paying that 15% withholding tax on your dividend. They're Canadian listed. That foreign income tax, all that is handled within the ETF, so you don't have to worry about that. So what is this, these ETFs all about? Well, again, they're single stock ETFs. They write covered calls on it, and here's the key: they're writing covered calls on up to 50% of the position. So this is the max. Doesn't mean they're writing up to 50% covered calls on the portfolio. They could go up to 50% writing. So it means that if they're writing maximum covered calls, you are capturing still at least 50% of the upside of these stocks. Of course, we're going to have tax efficient distributions, because remember, when you're writing covered calls in Canada, it's considered capital gains. So my estimate here, this is my opinion, is that a very, very, very high percentage of these distributions will be classified, probably over 90%. Again, this is my opinion. I'm just estimating here, will be classified as either capital gains and ROC. So very, very tax efficient. Low purchase price as well. They all started at about $12. Actually, they all started at $12. These were launched actually on August 21st. So if you look here, they all launched at $12, but of course some of them are higher than that because they went up, and some of them are lower than that because the stock went down, like the NVIDIA. So in terms of yields, which is the most exciting thing, and I almost jumped off my seat when I saw that. I was very, very impressed with the yields, which are very, very easy to figure out if you're starting the price at $12. If you're actually starting the price at $12, the monthly distribution rate is pretty much the yield on a $12 price. So the Lilly one, this is non-leverage, guys, 16% yield. The Amazon and Microsoft, 14% yield. NVIDIA, 18% yield. And if we look at the leveraged ones, and again, these yields are based on a $12 price, if we look at the leveraged ones, which of course you guys know that I'm a huge fan of, 18% on Lilly, 18% annual yield, 16 on Amazon and Microsoft, and a whopping 22% yield on the NVIDIA one, on the enhanced one. So very, very high yields. Absolutely fantastic on these if you're looking for high income in your portfolio. So I strongly suggest to go on the website, look at the FAQs, and so that's basically it, guys. It's not really rocket science to figure out. Obviously, these are ETFs that are only going to hold one stock. They're writing covered calls on it. There's leverage and non-leverage versions, Canadian dollar and .U versions as well, if you want to invest in them in USD currency. They all have a management fee of 40 basis points, identical pretty much to their competition, who also has single stock ETFs on the Canadian market. But one thing that's different is that they're all non-Canadian dollar hedged. And of course, Harvest is known for their really reliable and consistent monthly distribution. So now what the questions you're going to have is how sustainable are these dividends? What exactly is the covered call policy? Do they write at the money, out of the money? Are there going to be more of these products in the future? Why did Harvest decide to launch these now? So let's ask the man himself, Michael Kovacs, all these questions right now. All right, everyone. Michael Kovacs back on the channel, CEO of Harvest. How are you, Michael? Thanks so much for taking the time to come back on the channel.
Very good. Thanks for having us. We love being here.
All right. Glad to hear that. So let's get into it right away. You got a brand new launch. You even have like a nice little separate logo. I love that. I really like your graphics team did a good job as usual.
Thank you.
My first question, of course, is why did you guys decide to launch these single stock ETFs now?
They were like a natural extension of our product line. As you know, we've been in the covered call writing area for over 10 years, 8 years as an ETF company doing covered calls. And it just was a natural add-on to what we do already. And a lot of these stocks, all those four, they're all constituents in existing portfolios. So we're very familiar with the companies. We know about their option trading, the depth of those markets. So we were very comfortable launching these first four as an introduction to the Harvest High Income shares.
Makes complete sense. And that transitioned to my next question. You chose these four very specific stocks. So obviously Amazon, Microsoft, Lilly, and NVIDIA. So why these four stocks in particular did you guys decide to focus on?
Well, aside from the part that we are familiar with the companies, they are some of the most widely held companies in the United States, either trading on NASDAQ or the New York Stock Exchange. A lot of volume on these companies, very deep option markets as well. In the United States, a lot of different areas of the option chain, and we try to write 1 or 2% out of the money on a 1-month basis. So, there's a lot there that we can work with. And again, just getting back to the comfort level that we're very familiar with these stocks. And just in sort of some surveying we did as we were looking at launching this product, these were names that were coming up a lot. So we decided these would be our first four stocks.
Interesting. And you kind of already touched about it. You already know, I think, what my next question is going to be: the covered call policy, something obviously that is very important. So you said 1 to 2% out of the money monthly. Is this on all four of them? Or tell me a little bit about the covered call policy that you're going to have on these single stock ETFs. I from the website it says up to 50% coverage. So can you just go into detail about the actual covered call strategy?
Sure. So when you say up to 50%, that means you could be 0 to 50%, but to generate those yields, you're going to have to be writing. So right now at launch, we're about 33 to 35% written on all the positions. So in a very comfortable spot to generate those yields. Like with our other ETFs, we write anywhere from at the money to maybe 1 or 2% out of the money. And if you write on within a 30-day period, that's where you get your highest premium. So that's where your sort of implied volatility can be the highest. So it gives us the ability to write right now at that 33 to 35% range and generate that cash flow. So it's a very similar process to what we have for all of our major, more diversified ETFs. We're rating 33%, but this way we have a little more room to meet that yield.
That's pretty impressive. I mean, you're not even close to 50. That's the max. Okay, so 50 is the max you're going to go, but you're not even 50 while initially. And
Correct,
the initial yields kind of, I was taken aback by them in a really good way. I mean, so obviously you're going to have, the four, but there's leverage versions, there's non-leverage versions. And from by looking at the yields of the launch prices, we're talking between 14 and 18% yield on the non-leveraged, and
Correct. Yeah.
16 to 22%. Obviously, the higher one is going to be the NVIDIA on the
Mhm.
leverage version. So how are these high yields sustainable? Did you guys perform back tests? I know you always do that. So tell me a little bit about your mindset behind, or how can you assure investors, yes, these yields are sustainable?
Well, you're right. First of all, about the back test, we back test everything, whether it's one of our diversified portfolios or these individual stocks. We've got some very complex models where we actually run scenarios where you've got big declines or big or fast moving up markets, and how that affects the option chain. So to answer your first question, yeah, we will back test everything before we decide what those yields are. And then, Harvest has a sort of a reputation for trying to deliver consistent yields over the long term. So we're not trying to be the highest paying, but for that point, we want to be competitive out there in the marketplace. But writing at 33 to 35% really gives us a lot of cushion to generate those yields easily. I mean, you could see yields much higher. You could literally double the yields on some of these portfolios if you went right to the max of 50%, but then you give yourself very little wiggle room. If you get into, say, a market drop and then the volatility levels fall apart, you're going to be paying out these big yields that you can't really meet. So we'd rather be in the middle and feel
Hmm.
comfortable with those levels, just like we do on our other portfolios.
Yeah, no, that makes perfect sense. That's something I keep telling people about Harvest. For me, when I see anything Harvest, it's the specialty of your firm. This is just my opinion. You said it's the reliable, consistent distributions that rarely change month to month. They're typically very even. And a lot of investors, especially income investors who are relying on that income, who are
Hmm.
living off that income, are very appreciative for sure, for sure, for sure. So
Hmm.
yeah, pretty cool. I mean, near 33%, not even close to that 50, but you have that room there. And
Correct.
let's just say you get to 50. You're still capturing 50% of the upside if that's the case. That's if you're doing 50% at the money. That's like, big max. But even at that, you're
Right.
still capturing half of the upside of the stocks, which is pretty cool. So
Right.
and just sticking on the distributions, what would cause
Mhm.
you, or what would be a reason why you would either increase or decide to decrease the monthly distribution? Maybe we'll start with what would make you increase the distribution.
Um, if you think about, good questions, when you think about HTA,
Yeah,
our tech
the tech.
achievers, we've increased that 5 times now since we've started that fund. Once fairly recently. And what happens in a scenario like that, and it would be the same with these stock ETFs, if this price is rising generally over time,
Yeah,
and our right level to meet that commitment is actually dropping. So say we said 33%, but let's say, I'm just going to throw a number, 6 months from now, we're writing at 25%. We could probably increase that right level and bump that yield higher. So it's really a matter of, if that stock is slowly moving higher over time and our right level declines, that allows us to generate higher yields by writing more, or increasing the yield. So the opposite, and this is probably more what people have to think about, is there's really, for yields to be cut, there's a few different things that have to happen. Number one, won't name any particular stock name, but let's say a stock drops considerably, like
yeah,
33, 35, 40%. But if it rebounds back up quickly, you're fine. But if it drops and then stays down, what happens is your volatility levels start to drop. And
the NAV
more than the
goes
price
down
of,
too. So
yeah, so more than the price of the fund moving around, but to cut the yield, you'd have to see the volatility levels drop and remain low for a large period of time. And in that case, you've got two things working against you. And if that were the case, we would have to cut the yield. We're fortunate that we haven't had to do that, but you never know what's going to happen in the markets. But so there is a scenario where prices fall, they stay down, and volatility flattens out. Then you're probably going to be forced to cut the yield. If you can take your yield that you're writing up to 50%, still meet that, then you're okay. But if it falls that much, and that's considerable, and stays there, that would lead to a yield cut.
yeah, oh, it makes perfect sense. And I like the fact that you mentioned we have the cushion. We're not starting at 50, we're starting
Right.
at 32. So we have the room, but it's good that people understand that it is a possibility. Increases are a possibility, decreases are a possibility.
Mhm.
So I always say, my personal opinion here, if you're investing in any single stock ETF type product, you really got to like the stock, because you're really investing in that only in one particular stock versus, for example, HTA or HTAE, which is a group of 20 technology stocks. This is only one stock here. So
Right.
When it comes to, so you guys have leverage versions,
Hmm.
non-leverage version, and then within each you have .u. So .u, you could trade it in USD currency, the regular one, or the non.u is traded in Canadian currency, but both are listed on the Canadian exchanges.
Right.
So one thing I noticed is that all of these are non-Canadian currency hedged. So the
Hmm.
.u one and even the Canadian listed one, they're not hedged to Canadian currency. A lot of your ETFs are your covered call
Hmm.
ETFs. Why did you guys decide not to hedge the non.u versions to Canadian currency? Any particular reason for that?
Well, the reason why some of the other ones are hedged, it comes back to the history because sometimes the various versions were launched at different times. So a lot of the initial ETFs that we launched in Canadian dollars, we did hedge them. In the case of these ETFs, as you mentioned, there's technically four of each one, of each
Yeah,
stock.
there's four. Yeah.
Um, so if somebody's feeling more compelled about the US dollar, they like the prospects of it, then they've got the US dollar version they can buy. If someone feels more comfortable and their money's in Canadian dollars, you've got the Canadian version. You can buy both hedged, or sorry, both leveraged and non-leveraged.
Yeah.
Also, hedging does add a cost to the underlying structure. So it simplifies the structure somewhat as well. And because we have the two different categories, people can choose where they want to be. What we were trying to be with these stocks is sort of agnostic as to, we're not necessarily making a call on the stock or on the currency. It's you as an investor, you make the decision as to what you like. Do you want to use leverage and get the higher yield and potentially higher returns? Do you want something that's not currency hedged? Really, you've got to make that decision as the investor. So launching four, which seems like a lot, gives the options.
Yeah, no, that's great. I personally, you know me already, I love the leverage
Yeah.
version. If there's a leverage version of something, I would always personally invest in that one. And we're not
Right.
talking about much. We're still talking about your classic 25% leverage,
Hmm.
correct? This is not,
Correct.
and with rates going down, can you just confirm, of course, this is true, that it actually lowers your leverage costs on the leverage ETFs, not only these ones, but your entire lineup, because you are borrowing at the prime rate, I think it
Yeah.
is, right, for that
Correct.
leverage?
Yeah. So just in the last number of months in Canada, we've seen our costs drop 50 basis points. And let's hope we see another 50 before the year's up. So we think rates are going to continue to fall. So that will definitely benefit all leveraged products.
Excellent. That's great to hear. And there's other providers out there that have these single
Mhm.
stock ETFs with leverage, with covered calls. You do have some competition. So what are
Mhm.
the main differences, would you say, between the harvest ones and your competition? What sets you apart?
Well, I think I've sort of talked about it already. I think I know the competitor you're talking about, but they basically provide a US dollar leveraged hedged product.
It
And I
is
believe,
Canadian currency hedge,
yeah.
yeah.
Okay. And I believe it's leveraged and it's in US dollars.
It's it's
So,
it's in Canadian. You could trade it in Canadian dollars, but it is leveraged. Yeah,
right. Okay. Whereas we have really the four different options.
yeah.
None of them are currency hedged. Um, they're all priced at $12, so they're actually a cheaper entry point as well, which I think is important to take a position in. And like I said, you've got four different options. So, and your cost is about the same, but they're unhedged, and you've got four different variations, Canadian and US dollars.
I love choices as a
Yeah.
do-it-yourself investor. That's what I want to see. I like to make my own decision. So if a provider has multiple choices, for
Hmm.
me that's a slam dunk. So last question. I always have to try with this one. I know you guys can never
Yeah.
talk about future products, but I have to try. Are you planning to launch more of these in the future? Are you, or maybe I'll ask it in a different way. Did you launch these four to begin with to gauge the reaction of the market? What
Well,
can you say about
I
that?
can't answer that question. Our objective is to launch more of them.
Okay,
Um,
good.
I mean, I'm not going to say names right now, but that's our objective. So you're right. This is our uh, initial launch, and launching four of each. We can also gauge where the flows are. If the majority of the flows are going to US dollar leverage, then we'll probably continue to keep that class. If zero goes into, say, the Canadian dollar unleveraged, we'll keep these ones, but in future ones, we may not have that class. So it gives us, when you talk to a lot of people, you get a lot of opinions as to what they
For
want.
sure.
So
Yeah.
what you do is you bring out four, so it's actually four funds, four different stocks and 16 versions. And we'll see where the flows go to those. So to answer your question, our objective is to launch more as time goes on.
Excellent. I'm pretty excited about that. Another thing, just to wrap up, that I saw on your
Yeah.
website, how to use these ETFs. You actually, I'm going to go on your website and do my portion of the video earlier. But you say, why would someone invest in these? It's really, there's a couple of reasons. and we agree with I agree with you on that. It's really to hedge. Let's say you own Google, you own Amazon, you own Microsoft, you own Eli
Mhm.
Lilly. You could purchase something like this in parallel to hedge the risk, because adding covered calls to something actually hedges risk. It lowers risk. So is that the primary reason you think most investors are gonna get these? Or I also feel like maybe as an income investor, these could be added, just to boost the overall yield of the portfolio. So in your opinion and what you've been hearing, because you guys get a lot of feedback, what's the
Mhm.
number one or top reasons why a do-it-yourself investor would purchase these?
Well, the reasons you mentioned, individuals that own the stock already,
Yeah.
that maybe they want to take, and they've all done well. Maybe they want to take some of the position off the table and buy it back in a different vehicle with a high cash level. Um, there's also individuals that have portfolios where they want to, like you're saying, sort of hedge or balance off some of the growth side with the income side. So
Yeah.
it really comes down to, I'd say, individual investors. What you're really looking at is the desire to have income on widely held stocks. You've got all kinds of, like we have them, and there's all kinds of providers that have great diversified baskets of income generating products. We see this as a natural extension not only of our product line, but I think in Canada too, the market's now ready for more and more products. And I think the ETF vehicle is a fantastic vehicle to bring these out because they're market traded, they're open. So they trade and they have flows going back and forth every day. And we're seeing more of these products in the States. And I think we'll see more in Canada as we go forward.
I hope so. Yeah, ETFs are awesome. They're easy to buy. Easy, you could buy and sell them like a regular stock. They're
Mhm.
lower fee. They're easy to understand. They're open ended, like you mentioned. So it's just fantastic. So
And you're not
uh,
dealing with costly structures to get in and out of these things. So they give that flexibility to investors. I think it's a great product and has brought a lot. It's sort of democratized investing. It's helped to democratize and bring more investors into the market.
yeah, for sure. And I mean, the management fee, they're all 40 basis points on
Yes.
these. They're very, very low, very, very competitive. I would definitely not want to do the run a cover call strategy myself. That scares me. I don't even have options enabled in my broker account. I'd rather leave it to the professionals like you guys who, first of all, live and breathe these stocks every day, because you know these by heart. You have them in your other portfolios. You're already writing calls on them in your other
Mhm.
portfolios. And I probably cannot do better than your Paul and your traders there's no way. So
Well,
yeah,
you make a good point. You make a good point. Even for like advisors, um, the world's becoming much more complicated, and it's much easier to have somebody take care of that for you. And if you can do it at 40 basis points, it's a pretty good offer.
it's a very good offer, yeah, in my opinion, for sure, for sure, for sure. Consistent monthly. So, guys, I'm talking to my audience here. This pretty much sums it up. So, you have the classic harvest way here. You have a in the middle approach with the cover call. You're still capturing most of the upside if you're writing at 33, 35. You got multiple options on which ones you want to choose: leverage, non-leverage, and you have that classic harvest advantage, which are typically super, super stable monthly distribution. So, Mike, that's it for the questions. I have nothing further. I appreciate your time and looking
Thank
forward
you.
to the new launches. My audience is always looking forward to new products to choose from. We absolutely love them. So thanks for taking the time, and we'll have you back soon, I hope.
Thank you. And thank you to you and your audience. We appreciate all the support.
Appreciate it. Take care.
Take care. Thank you.